Let's get talking now. The Central Bank of Nigeria's Monetary Policy Committee has further increased the interest rate by 0.5% to 18.5% from 18%. The governor of the Apex Bank, Mr. Godwin Emefiele, says the committee's decision is in order to curtail rising inflation in the country. Take a listen to Mr. Emefiele while presenting the MPC communiqué.
Because we feel that we owe Nigerians the explanation that, look, we have been aggressively raising rates. Why is it that inflation is not coming down? But we've said in the last 2-3 meetings that yes, that we could see that it is the rate of deceleration is, that it is coming down gradually. Because if you look at the drop in the rate of inflation month on month, you will find out that we are seeing some results.
Well, let's talk more around this, and joining me to break this down further is an economic and investment strategist, Mr. Ayorinde Akinloye. Mr. Akinloye, thank you so much for your time. And I would ask you very quickly, were you expecting the CBN to still maintain this trend following not very visible impact on inflation rates? Do you think this is working for us as a country?
Okay, thank you very much for having me on the show, Tolu. It's always a pleasure. First, I think in terms of was I expecting the CBN or the MPC to actually raise the MPR by 50 basis points at yesterday's meeting? Yes, it was mainly expected from yesterday's meeting because when you look at the CBN's body language or the body language of the MPC committee members, a lot of their focus has always been around inflation, and they always tilted more towards the side of economic theory than probably maybe the realities of what is actually happening, considering the realities of the Nigerian economy where we stand right now. So, and looking at the results of inflation figures since the last monetary policy meeting, we still continue to see inflation stubbornly high, and that was largely what was expected from them for them to do, even though we can still question the fact that if are these rate hikes actually working, which I'm sure we are going to discuss further on the program. But yes, that was largely the expectation from my end, that they were going to raise, maybe 25 to 50 basis points, and that was what we saw play out yesterday.
Let's now talk about the impact of this on the cost of lending first. We have manufacturers, we have business people who have already put their monies down. We have companies that have made projections before now. All of this will change all of the narrative.
Yes, definitely. Although, interestingly, if you look at it's the survey that the CBN normally release of lending rates from a lot of commercial banks. So let's take a step back to about a year ago. In April 2022, before the first rate hike in May 2022, the maximum lending rate was about 27%, thereabouts. The prime lending rate was about 11.912%. That's in terms of average across the banking system. But if you actually look at where those rates are at today, the increase has been, whereas the MPR has increased by a cumulative of about 700 basis points between then and now, or between about 700 basis points between then and now, those key rates have actually increased by less than 200 basis points. Yes, that has led to an increase in cost of lending, but it has not been as aggressive as you would have expected, given the decision by the CBN to actually raise the MPR by over 700 basis points within that period. So it speaks to the fact that, the monetary policy rate has not been effective in sort of combating accelerating inflation, and it has not necessarily raised the cost of borrowing significantly as you would expect. The only other place where we can see there has been a bit of an impact is in reduction in money supply. But again, that is sort of weakening the demand segments of the economy, which, again, if you ask me, the aggressive demand or strong aggregate demand is not the major reason for why we are experiencing the inflation we are seeing today. And if you look at the comments from the CBN governors or the MPC's communique yesterday, they acknowledged the fact that there are a lot of supply side factors that are actually driving prices higher. So you have the fact that there's scarcity of petrol. We have the fact that insecurity in a lot of the food producing states, in the middle belt and the northeastern states, has not been resolved yet. And as a result, you have reduction in food supply. There are still a lot of supply chain challenges, even across non-food commodities that we can highlight. Energy and price of other energy components are also going up. So, and then you also have the aspect of foreign exchange pressures, which has also led to an increase in price of a lot of imported items and products where we import raw materials to actually produce those items for the ones that we produce within the country. So when you put all these things together, you begin to ask yourself, how effective would an interest rate hike be in combating these issues? So these issues are more fiscal driven than monetary driven. But the body language of the MPC is, we still believe this, for them, they still believe that there is a demand pull component of the aggressive inflation that we're currently witnessing in Nigeria. And a result of that, they decide that they would raise rates to continue to combat and weaken aggregate demand. But in terms of when you now bring it down to the businesses, even the aggregate activities of a lot of businesses within the country, when you look at the aggregate consumption of Nigeria, the business component of that is less than 20%, because consumers contribute roughly 60 to 70% of aggregate demand within the Nigerian economy. So how much of an impact will that have in terms of curtailing aggregate demand if the increase in interest rate is mainly targeted at that segment of the economy? Because the consumer segment would not really be targeted, because a lot of consumers actually don't consume, their consumption is not credit backed. Percentage of consumption in Nigeria that is credit backed is less than 10%. So this category of consumers are not affected as much. It's mainly the businesses that will be impacted. Now, going forward, would this sort of now lead to negative impact on inflation? Because all it means is, for me as a business, if my cost of borrowing is going up, it's basically impacting the cost of me accessing capital to produce goods and services, either from a working capital perspective or from a capex point of view. And what that means is, I would have to, if the increase is significant enough, then I would have to increase my prices and pass that increased cost on to consumers. So it could be counterintuitive in the long run when you look at it and you look at it down the line. But basically, the monetary policy, as the MPR, as a monetary policy tool itself, has not really played its role, one, in the aspect of combating inflation, and even two, in the aspect of driving cost of borrowing up. Because what we are seeing based on survey from central bank data is that the increase in prime lending rates and maximum lending rates is not commensurate with the increase we are seeing in MPR. Whereas MPR has increased by about 600 to 700 basis points, all those lending rates have increased by less than 200 basis points.
Interesting stuff there, Aki. But let's stay with the currency issue. And we know that most currencies, not just the Naira, being battered at the moment. And we see that many countries are also, especially countries like us, facing issues around Forex scarcity, which the central bank has introduced a lot of initiatives trying to address this trend. The recent one is the RT 200 billion, which they've been speaking around. But let's look at some of these initiatives now. As much as I agree that the fiscal side has a role to play, what is your take with regards to the positives from all of these initiatives trying to address? There's been a little bit of stability in recent times, even at the other market, between 730, 740, at least nothing above that in recent times.
Well, again, we've discussed time and again. Yes, you would always have periods of stability on the exchange rates. Have months of stability, but as long as the fundamental issue of not earning adequate effects as an economy still remains, we will still continue to face currency pressures in the future. But in terms of evaluating the impact of other monetary policies, that the CBN has put in place, particularly as it relates to exchange rates, it's really difficult to tell how much of a positive impact that has had so far, because when you look at when you look at official data available on, for example, how much dollar inflows have come into the country through the RT200 FX policy, how much dollar inflow has come into the economy through the Naira for Dollar scheme that the CBN announced a couple of years ago. We can't really get valuable, accurate data on those dollar inflows. And I'm sure if we have gotten significant amount of dollar inflows from these policies and from these initiatives, definitely we should actually have been seeing the Naira appreciate. And we've actually not seen that, take place since since the RT200 FX policy was established. I think the Naira has actually lost value significantly, even, despite the announcement of that policy. And it basically speaks to the fact that if we don't work on improving the business environment and driving investments into business activities that would help us produce goods that we can export, outside the country, then we would still continue to suffer from strong pressures on our exchange rates. So I would say, in terms of how effective those policies have been, I think they can be more effective. I think more can be done if we improve the infrastructure side of things, if we improve the fundamental part of the business environment of the economy, in which we encourage businesses and we encourage investments in those ways. Because if we take a step back to look at what the RT200 FX policy was meant to achieve, for example, if we pick that specific policy, to actually look at what it was meant to achieve, it was meant to achieve, forward integration in the agricultural space, right? So for a lot of cocoa, maybe for example, cocoa farmers that produce cocoa, when they harvest their cocoa, they basically export it in the raw form abroad, and we get less value for that. So the CBN was trying to encourage them, invest in the processing equipment, the storage facilities that will require you to process these products into intermediate products, into cocoa powder, into cocoa butter, into chocolate, into all these different products, so that when you are exporting these commodities, you are getting more value for our exports. But the truth is, we have not seen that response from investors. We have not seen, farmers and other investors actually invest aggressively in this space. Why? Because there's that concern about the aggregate business environment, about the fact that, even as a farmer, you can't guarantee the security of your workers on your farm due to insecurity issues that is plaguing the country. So these are all factors that we can't do away with. As much as we are establishing policies on the monetary side, there is need for cooperation on the fiscal policy and the government side of things to actually ensure that these monetary policies work. Because without the fiscal side being in good condition, there is a limit to what the monetary side can achieve.
Before I let you go, Ayo, let's talk about the ease of doing business initiative of this outgoing administration and a lot of bills being signed, business facilitation bill. I can even mention the PIA that to also, help streamline activities in Nigeria's oil and gas industry. We have the startup bill and all of that. So many would say that the fiscal side, they did a bit in trying to support the monetary side. Or what would you say of all of these positives? What impact really did they have around the business environment?
Well, in terms of the policies, right, when you look at the current, the outgoing administration, let me say, has actually implemented quite a lot of, we've seen lots of bills being signed, lots of accent and everything being done. But again, it's still down to implementation. You can announce and create 100,000 policies. If the institution and institutional framework and the people that would implement these policies are not put in place, then there is a huge likelihood that those policies would not be effective. And I think that's what we have seen played out. We've seen lots of policies that have sort of, put the government in a position where from the outside looking in, you are saying, they're basically playing to the gallery, not necessarily actually implementing the policies such that you're able to feel the tangible impact on the aggregate economy and the business environment. So I would say if there's any lesson that needs to be learned from, what we have seen over the past 8 years, is about as a government, when you're, maybe probably for the incoming administration, when you are signing these bills into law, when accents have been given to these bills, and we are announcing that, okay, yes, we have PIA, we have the KAMA Act, the revised KAMA Act, and the amended KAMA Act, and things like this. As you're doing that, you are also empowering institutions that are going to see to the implementation of these policies that are being passed by the government. Because if you have policies that are not implemented properly, what you end up having is everybody just keeps doing things like business as usual. But if you have the proper institutional framework around a lot of these bills and around a lot of these laws and policies that are being established, then what you are likely going to see is, the positive impact and the end result of those policies as you intend them to actually perform. And the second thing is, it also helps you to measure. So when you want to evaluate your policies as a government, so you announce a policy a year after, you want to look at it, is this policy working or is not working? But if you have actually not put in measures, you've not set targets, you've not set implementation frameworks for all these policies, it's going to be very difficult for you to be able to come back after a year plus to say, okay, we actually want to measure and see how effective these policies are. Have they been effective? Are they not effective? And without having a framework in place and set targets, you actually won't be able to measure how effective those policies are. And it basically, makes the whole process not worth it in the end. So that's what is the most important thing. Yes, lots of these policies were passed, but how strong were the institutional frameworks and implementational frameworks around those policies? Those are things that we also have to look out for as we improve our economic policy making process.
Ayorinde Akinloye, economic and investment strategist. Thank you so much for spending your afternoon with us. We really do appreciate this.
Thank you very much for having me. It's always a pleasure.